Instead of saying, oh, 3,500, that was the peak and now it's going down, it seems to hit a floor, and I think it's the central banks. Now, the central banks, they're not going to send it soaring super high. They're not trying to make it go higher, but they're not stupid. And if they see a sale price, then they're likely to take advantage of that. So I'm not expecting the central banks to send gold over $4,000 an ounce or whatever target you like. I'm expecting central banks to keep it from melting down too much, and that has stuck all year. I'm expecting inflation, chaos, geopolitical turmoil. I'm expecting those sorts of things to push monetary and safe haven assets upwards. So my bull case is not the central banks. The central banks is sort of my bear trap, or my bear protection, if you will.
Gold's rally today is built on sovereign demand, not fleeting speculation. Lobo Tiggre emphasized that many observers have wrongly compared today's strength to the rapid surge of 2011 to 2012, assuming it would collapse just as quickly. Instead, gold has spent the past year and a half consolidating at higher levels, moving sideways in a range that demonstrates durability rather than fragility. Unlike the 1980 blow-off top, which quickly reversed, the current market is showing staying power at elevated prices. Rather than focusing on resistance points, Tiggre highlighted the importance of the floor near $3,300. When gold spiked to $3,500 and then retraced, he admitted that in the past he would have warned of a correction. But this time, the repeated ability of gold to hold key levels has changed the narrative. Instead of signaling weakness, the pullbacks are creating stability, reinforcing the idea that gold's foundation is solid and not vulnerable to a major reversal. At the heart of this resilience is the role of central banks. Tiggre explained that central banks are not attempting to drive a dramatic rally, but they consistently step in to buy during dips, preventing sharp breakdowns. This steady accumulation helps explain why gold has been able to maintain a strong floor while avoiding the speculative excesses that typically lead to collapses. For this reason, Tiggre doesn't expect a runaway move above $4,000, but he does believe central bank demand will keep the market firmly supported, ensuring gold remains a strategic asset in the global financial system. Before we dive deeper into the discussion on gold, silver, and the unfolding changes in the global monetary system, don't forget to like this video, subscribe to the channel, and hit the bell icon so you stay updated with every new insight.
No surprise to anybody whose job wasn't to lie in public, I think. But anyway, so when that happened, there are all kinds of people saying, oh, this is 2011, 12 all over again. It's just gone up too much, too fast. It's got to crash back down. And guess what? It consolidated and made this other big move that we've now seen over the last year and a half. Now, so you could say, okay, well, now this time's really it. But if you remember the chart that you started with, that peak on the right is actually sideways for months now. Mm-hmm. Yeah.
Yep.
This is not at all like 2011. It is not like 1980 either. I mean, if you're, no, sorry, my young brother, you're not going to remember 1980. I do. I was just a kid, but I was in the market. I was buying silver, not gold, with my lawnmower money, but I was in the market, and I remember 1980, and that peak lasted less than a day. That $855 peak lasted less than a day, and the $800 peak lasted less than a month. It was like $600 shoulders on that puppy. So what you're looking at here is really significant. And now this doesn't prove that gold's going to the moon or 10,000 tomorrow or any stuff like that. Don't put a clickbait headline on me, Daryl. But it does mean these people who are like, oh no, it's gone up too far, too fast. Therefore it has to correct. Well, they were wrong in 2000. They were wrong earlier this year. And I would caution anybody against believing anybody right now that says, oh, this is it. It's gone too fast. It has to break down. That is an insufficient argument. That would need to come to me with something like, what's changed? Why would it? And I don't know how far down this rabbit hole you want to go, but just real quickly, I think the central bank buying that started under Biden with the weaponization of the dollar in response to the second invasion of Ukraine, I think that's an absolute game changer. You don't just have deep-pocketed investors. You've got freaking sovereigns out there, the deepest pockets of them all, buying gold like there's no tomorrow, which, given the geopolitical news, there might not be. Who knows? All I'm saying is this is a very different market than we've had in the past. It's very dangerous to assume, things that you've seen in the charts in the past must prove, therefore, what happens next. And given that new reality, given that game changer, I've been saying all year since we hit 3,500 the first time on the futures that, as peaky or toppy or whatever you want to call that as that seems, I just don't see a lot of downside risk. There's a huge pool of money that's a determined buyer in the space, and that has obviously changed the game. That's right. I would flip it slightly backwards. Instead of looking at the resistance, I've been looking at the floor around 3,300 plus or minus. And for something to go, look at this chart you've got on there right now. For somebody to go screaming up to 3,500 and then correct down to around 3,300, or things being as they were before, I probably would have been having, rotten tomatoes thrown at me and people saying I hate gold or I'm a fair weather friend or something, because I probably would have been saying, guys and gals, 3,500, that's a CPI adjusted all-time high. A correction here would be reasonable to expect. And it's made me really nervous all year long that I haven't been doing that. I'm usually the guy who gets booed for saying, look, hockey stick, it's time to take some profits here, right?
Yeah.
And I haven't been saying that. Well, I do always say you can't go broke taking profits. But I've been saying that, again, flipping it upside down, instead of looking at the resistance, I'm looking at that floor. And to me, it's striking that we have seen a lot of headlines all year long that until recently would have been very bearish for gold. Things that would, smack the gold around, whether it's, the flip-flops on the tariffs or whether it's the Fed doing this or not doing this. And every time that happens, we get a little drop, Daryl. Instead of saying, 3,500, that was the peak and now it's going down, it seems to hit a floor, and I think it's the central banks. Now, the central banks, they're not going to send it soaring super high. They're not trying to make it go higher, but they're not stupid. And if they see a sale price, then they're likely to take advantage of that. So I'm not expecting the central banks to send gold over $4,000 an ounce or whatever target you like. I'm expecting central banks to keep it from melting down too much, and that has stuck all year. I'm expecting inflation, chaos, geopolitical turmoil. I'm expecting those sorts of things to push monetary and safe haven assets upwards. So my bull case is not the central banks. The central banks is sort of my bear trap or my bear protection, if you will. And I remember my contribution to that, my call was actually in late 2007. I basically emptied all the industrial metals plays out of the portfolio, and we were just gold and silver and maybe some uranium, but not 100%, but basically cleaned out the copper and everything else from the portfolio, which in 2008 turned out to be a great move. That really helped a lot. So 2008 happens. A lot of people are very upset, but our readers, they were somewhat prepared for it. And the problem became actually that, the stocks went off and gold got sold for the wrong reason, right? As a liquidity resource. It got squeezed temporarily in 2008. And then a lot of our readers were ready for that. They expected that. So they started buying. But then it got worse. It's like it fell off the head onto the shoulders, and then it fell off the shoulders onto the lap, and then it fucking hit the floor. So along the way down, we had a lot of people averaging in. So by the time the actual bottom came, a lot of people were liquid. And that was agonizing. I remember the agonized emails from those days of like, I get it, I see it, I'm sure it's going to rebound, but I'm all in. I can't take advantage of these bargains. And that has had a strong impact on my own ways going forward. But we're nothing like that today. And even in the corrections we've had since 2020 and the big breakout for gold, never mind the new one, the attitude hasn't been there. But instead of just storytelling, let me tell you something that I think might be more useful here for the audience. In 2011, 2012, after that big run up in gold, almost to 2,000, and then it waffled, volatility sideways for a while before going on that horrible 5-year slide, right? When that happened that year, the gold stocks led the way down. So the market sentiment when gold was going up and it went over 1,900 an ounce intraday, the market sentiment was actually very positive. But the industry insiders, or the, the smart money, if you will, they had already turned bearish. And the gold stocks, I repeat that, led the way down. This time, it's very different. The gold stocks have been kicking and screaming upwards. The metals led the miners in a big way this time. There was a lot of suspicion, I think, because of what happened last time. So it's only been recently that the miners have really started waking up, really over the last year, maybe year and a half for the better ones. But in the last couple quarters, even the not so better ones, I'm trying to be nice here, not get sued. A lot of the ones that are not the ones most famous for excellence of operations and high margins, even those have started delivering the leverage to the underlying metal, which is our reason for buying them. So I think this is a measurable phenomenon, and it is different. It's telling us a different signal. Instead of the gold stocks leading down right now, the gold stocks are still playing catch up. And this doesn't prove anything. I'm not saying that, 100 times out of 150 cases, that's like, I don't have statistics. All I'm saying is that it's different from last time. And to me, it's a bullish signal.
Lobo Tiggre highlighted the significance of gold and silver moving in tandem, noting that during silver's previous surge to $39, gold had barely reacted while other industrial metals were rallying. This time, however, both metals are advancing together, which he sees as an encouraging sign that the market is once again recognizing silver's dual role, not just as an industrial resource but also as a monetary asset standing alongside gold. He further underscored silver's growing importance by pointing out that, after being overlooked for years, it was recently added to the U.S. government's critical minerals list, joining gold and uranium. For silver investors, he described this recognition as a major step forward. At the same time, Tiggre cautioned that despite markets showing signs of rolling over, gold's $40 surge and silver's move above $40 demonstrate notable resilience. He tied this strength to massive global stimulus, reminding us that trillions of dollars have been injected into economies worldwide, fueling inflationary pressures. He argued that the current U.S. administration, while claiming the hottest economy in the world, would likely counter any recession threat with even more stimulus. Similar dynamics are playing out across the globe, with Europe committing €1 trillion to rearmament, China continuing to push stimulus measures, and Russia sustaining inflation through wartime spending, all factors that reinforce the bullish outlook for precious metals. Let's get back to the interview.
But I bring that up because the recent run-up you've got on the chart here for silver, when that happened, gold wasn't moving. However, those other silvery industrial metals were. So I've been not bearish on silver. I know people like to call me Darth Silver and all that stuff. I'm trying to be objective, right? And, when that big silver move happened up to 39 before, gold wasn't moving. So it was hard to make a case that that was on the basis of a monetary metal response or a safe haven response. And other industrial metals were moving. So it looked more like silver's industrial side. Today, again, I haven't looked at those other silvery metals, but today it looks to me like gold and silver are moving together clearly, and that's great news. I'm always encouraged when I see that Mr. Market remembers. Oh yeah, silver is also a monetary metal. Yeah, well, never say never. I mean, the markets have rolled over as you and I are speaking. Gold's up $40 an ounce, silver's over 40 handle on silver. The broader indices have rolled over and they're all in the red. This could be it, Daryl. This could be the beginning of the next big slide. But it might not be. Every shock that we've seen, as you've just outlined, has failed to deliver that. And I see this as a sign of what, I don't know if you've interviewed Michael Howell, he calls global liquidity, or Lynn Alden, fiscal dominance, or my simple, humble wolf, I just see the money helicopters in the sky. But basically, trillions and trillions of dollars thrown at these things. And that has to have consequences. And it has clear consequences for monetary metals, but it's also inflationary, which has consequences basically for anything real, anything you can't print. So, and it's an interesting thing. As bad as 2008 was, I remember Bush sent people stimmy checks and they're like $100 or $80 or something like that. I mean, nothing like the thousands of dollars that we sent in response to the COVID lockdowns. And I don't want to get Trump fans mad at me, but just ask yourself, whether you love Trump or hate Trump, doesn't matter. Ask yourself, do you think this president of the United States is going to sit there and let a recession happen without ordering the money helicopters redouble their efforts? I mean, this just doesn't look like something that this president would do. He's making America great again. He's said on TV that we now have the hottest economy in the world. That's been his mantra for months. We got the hottest economy in the world. If anything starts looking not so hot, you think he's just going to sit on his hands? Of course not. Yes, that's a forward-looking statement. No, I don't know the future. I'm just
he
calling
did
the
sign
odds,
those checks in 2020.
Yeah, the COVID thing started under Trump. So all I'm saying is, oh, by the way, and it's not just America. Europe is going to spend €1 trillion on rearming. That's kind of scary by itself, but that's a lot of money, and that's also inflationary. And China, they have been running stimulus after stimulus since the COVID lockdowns. That hasn't stopped. And Russia's got a wartime economy, that's always inflationary. So money printing up the wazoo around the world, it's not just a U.S. thing. And if there is, some element of Trump shock that really does put the economy in a tailspin, we've got an important labor report coming up. Not a true labor report necessarily, but I think an important one, because those numbers have started to break down. And while the jobless claims in the U.S. haven't been record high levels or anything like that, the continuing claims have been very high, at their highest levels since the COVID lockdowns for a while. It's like this huge wave of companies so far seem to be holding on to people, not firing people so quick. But when they do lose them, they don't replace them, and it's hard for people to get a new job these days. I think the odds are this will show up in this coming labor report, and whether that sends markets into a hissy or not, who knows? Bad news can be good news. And if I'm not the only one, I'm sure, who thinks that the response from the White House will be more easy money. And remember, Trump still controls Congress too. So even if the Fed drags its feet and says, "Oh, inflation is high too, so we don't want to get too easy too quick," well, that's not where all the money helicopters are parked. There's some of them on Capitol Hill as well. So Anyway, all I'm saying is, if there's a big market kerfuffle, I think they're going to throw even more money on it, and that's game on for monetary metals anyway. If there's no market kerfuffle, you're going to build a refinery, let's say, because Trump is encouraging that. That's going to take longer than the rest of Trump's presidency. And what if the next president doesn't like hydrocarbons as much as this one does? It's very difficult to, and this isn't just, chump change of an investment decision. Even for the biggest oil companies in the world, building a new refinery is a major commitment of capital. It's just really hard to see committing that kind of capital, even if Trump is true to his word for the rest of his presidency. That's simply not a long enough time frame for that decision. You really are taking a leap of faith if you do it based on that. And again, that's not even a criticism. I would like to see more energy produced in the United States.
Yeah.
So I'm not trying to knock the agenda. I'm just saying, as a business person, you need to be realistic about these things. There is an investable side of this, though, Daryl. If you've got a shovel-ready project in the United States, especially if it's one of these critical minerals, and by the way, the original White House EO on critical minerals included uranium and gold, the two yellow metals, so that made me very happy. This most recent one, just this last week, included silver for the first time. So silver bulls, rejoice. You're no longer left out in the cold. Somebody finally realized that silver is a critical mineral too. So yeah, if you've got something that's shovel ready, unless it's one of these giant, world-class multi-billion ton, mega deposits, that could be built and start cash flowing during this presidency. So that is material. Or even if you're not at that development stage, if you've got a real discovery that's going gangbusters, and now you're going into the permitting phase, well, this administration can accelerate that permitting phase. So that boring engineering phase that people get stuck in between, that can be shortened to the benefit of investors in those companies here. Just getting that unlock of getting to that permit before Trump's gone could make a big difference.
Today's gold and silver markets are operating under very different dynamics compared to past cycles. Central banks have emerged as steady buyers, cushioned the downside and ensuring that short-term shocks no longer trigger deep sell-offs. Unlike in 2011, when miners led the way down, this time they are catching up to the metals, a signal of underlying strength. Silver, too, is once again being recognized as a monetary asset rather than just an industrial commodity, reinforcing its safe haven role. Added to this is a global backdrop of relentless money printing, inflationary pressures, geopolitical turmoil, and supportive U.S. policies on critical minerals, all of which strengthen the case for precious metals as both protection and opportunity. Are gold and silver entering a new sustained uptrend? Stay tuned. If you're interested in real, data-backed insights on the financial system, hit like and subscribe so you never miss weekly updates. Thank you for your support, and we hope you enjoy the video.